Most people think the economy is controlled by governments, or central banks, or corporations, or markets, but those are only the visible parts. Beneath all of them, there's another system quietly shaping what is possible: credit. Credit decides what can expand, what gets funded, what gets delayed, and what survives. It influences housing, business growth, asset prices, consumer spending, government budgets, and even what kind of future becomes affordable. You rarely see it directly, but almost everything in the modern economy moves through it. And once you understand that, the economy stops looking random. It starts looking like a system built around access to expansion. What most people experience is the surface layer: prices, jobs, rent, wages, interest rates, stock markets, headlines about inflation or recession. But those are outputs. They are what the economy looks like after deeper forces have already moved. Underneath that surface, the economy is constantly being shaped by balance sheets. Who can borrow? Who can lend? How much risk can be taken? What kind of repayment is expected? What collateral is accepted? What timelines are considered safe? That deeper layer matters because modern economies do not only run on money, they run on future money, on the belief that future income, future growth, and future repayment will justify decisions made today. That belief system is credit. People often talk about money as if it were the core of everything. But in modern economies, money is only part of the story, because money that already exists is limited. What expands the system is not just money, it is the creation of claims on future money. That is what loans are. That is what bonds are. That is what leveraged investment is. That is what mortgages are. The system grows not only by moving existing money around, but by bringing future income into the present. That is why credit matters more than cash. Cash settles, credit expands. And modern economies are built to expand. This is where many people misunderstand the system. They hear credit and think debt, burden, something risky or personal. But credit is not only a household problem. It is the hidden infrastructure of growth. Businesses use it to hire and invest. Governments use it to spend before tax receipts arrive. Developers use it to build. Consumers use it to buy. Banks use it to create assets. Investors use it to amplify returns. So credit is not an exception inside the economy. It is one of its main operating principles. Without it, growth slows sharply, because expansion usually begins before the cash exists to fully fund it. That gap is bridged by credit. Once you understand that, another pattern becomes visible. The economy tends to favor sectors that can absorb large amounts of credit safely. Housing is one. Government debt is another. Large corporations are another. Financial markets are another. Why? Because these sectors can hold leverage for long periods, and because the system trusts their ability to support repayment, that makes them attractive destinations for capital. It also means the economy does not distribute expansion evenly. Credit flows toward what the system considers stable, scalable, and collateralized. That is why housing rises faster than wages. That is why asset prices move differently from labor income. That is why large institutions can keep expanding while smaller actors struggle. The system rewards what can carry debt without breaking. This is where people often simplify too much. They think central banks control the whole economy directly. They don't. What they control is the price of money at the center of the system. They influence rates, liquidity, emergency stability, banking conditions, expectations. But they do not decide how every dollar gets used. That happens through the broader credit-structured banks, markets, governments, investors, and borrowers. Central banks shape the environment. They do not micromanage the outcome. Still, small shifts in rates matter enormously, because when the economy depends on borrowed expansion, the cost of borrowing affects almost everything. A lower rate does not just make debt cheaper. It changes what becomes possible, and a higher rate does the opposite. That is why rates matter so much. They are not only prices, they are permissions. One of the clearest effects of a credit-based system is that assets become central, not just because people want them, but because assets can be financed, held, leveraged, and used as collateral. That makes them perfect containers for credit expansion. A home is not just shelter, it is collateral. A stock is not just ownership, it is a claim on future income. A bond is not just lending, it is a structured expectation of future payment. This means the economy increasingly revolves around things that can support layered claims. And that changes the entire social structure, because if growth is flowing first into assets, then people who already own assets sit closer to the source of expansion. That is one reason inequality becomes structural, not accidental. Labor matters enormously, but labor does not scale through credit the same way assets do. A worker is paid after time is spent. A business or investor can expand before gains are realized. That difference changes everything. Wages grow slowly. Assets can reprice quickly. Labor income is taxed as it arrives. Asset growth can remain unrealized. Workers often need cash to move. Owners can often borrow against what they already hold. So even in a healthy economy, labor and ownership experience growth differently. This is not because labor is unimportant, it is because the system is organized around financing, collateral, and future claims. Labor powers the real economy, but credit often decides who scales first. This also helps explain inflation. People often imagine inflation as too much money, or greedy companies, or government mistakes. Those can all matter, but inflation in a credit-based economy often reflects something deeper: persistent expansion meeting real limits. When credit keeps flowing into housing, assets, consumption, or governments, the system keeps trying to grow. But real production, real labor, real land, real energy, and real logistics still have limits. Inflation appears when expansion outruns what the real economy can absorb smoothly. That is why inflation is not just a monetary event, it is often a structural one. Too much future pulled into the present, meeting a world that still has physical constraints. Once you see the hidden system, crises stop looking random too. Credit expands, confidence rises, asset prices climb, more leverage seems justified, risk looks manageable, the system stretches. Then one of three things happens: repayment weakens, asset values fall, or the cost of carrying debt rises. That is when stress appears. And because the economy is built on interconnected balance sheets, one pressure point can quickly affect many others. This is why crises often feel sudden. The visible break appears late. The invisible stretching happened much earlier. By the time headlines notice the failure, the hidden system has usually been under pressure for months or years. Even governments are not outside this system. They rely on debt markets, tax receipts, growth assumptions, refinancing conditions. That means they also operate inside the same credit architecture. They can influence it, shape it, support it, and stabilize it, but they are also constrained by it. This is why policy often feels reactive. Governments promise growth, affordability, stability, and support, but if the system underneath is built on ongoing expansion, then many political choices become narrower than they appear. Because not every desirable outcome is compatible with the structure that needs credit to keep moving. This is the hidden system, an economy organized less around what already exists, and more around what can be financed. That does not mean production is fake, or work is meaningless, or value is imaginary. It means the system's engine is not simple exchange. It is leveraged expectation, future income brought forward, future value priced today, future repayment assumed as the basis for present expansion. Once that pattern dominates, everything begins to orbit around it: policy, asset prices, housing, growth, inequality, and inflation. The economy becomes a machine for deciding which futures deserve funding now. Once you understand that, many things start making more sense. Why housing is protected, why asset prices matter so much, why central bank rate moves change everything, why debt keeps growing, why wages lag assets, why inflation feels structural, why crises repeat, why policy often looks trapped, why ownership matters more than most people realize. These are not isolated issues. They are connected outcomes of a system built around credit-led expansion. And once you see that, the modern economy stops looking like a collection of separate problems. It starts looking like one architecture, expressing itself in different ways. The hidden system that controls the economy is not a person, a party, or a secret committee. It is the structure of credit itself, the rules around leverage, the cost of money, the flow of lending, the preference for collateral, the dependence on future repayment. That system shapes what can grow, what gets rescued, what gets priced first, and who stays closest to expansion. And until people understand that layer, the visible economy will keep looking confusing, because the surface only makes sense when you understand the machinery underneath.